Page 176. We obtain the tax by comparing the tax expense reported by N. Taylor $51.2 with the income before tax $131.4, resulting in a tax rate of 39%. 131.4 divided by 51.2. We determine the total debt by adding together the long-term debt and the deferred lease cost and other liabilities on balance sheet, including the current portion of long-term debt from the current liability section. We can then compare the above measure to the composite market return required by suppliers of both debt and equity capital. Commonly referred as to the company's weighted average cost of capital, WACC. However, this calculation is beyond the scope of this book. We will provide more discussion on the estimating of cost of equity capital in Chapter 14, Cost of Equity Capital. Shareholders. Shareholders of a firm leverage their investment by borrowing additional funds from debt holders to invest in additional assets. Trading on equity refers to the use of leverage to generate a higher ROE for shareholders. Because ROC provides a measure of the return to invest in assets before distributions to any capital suppliers, shareholders can generate higher returns to themselves. ROE as long as ROC on asset financed through debt exceeds after-tax interest rate charged by debt holders. In other words, the cost of debt capital, whether shareholders will benefit from trading equities in the long run, depends on the trade-off between the added risk of the positions and the added expected return. Note that N. Taylor generated an ROE of 12.1% versus an ROA of 8.5% and an ROC of 10.3%. This indicates that they have used the leverage to their shareholders' advantage, and ROE is greater than either ROA or ROC. Recall from the decomposition of ROA, we calculate the benefits margin by dividing net incomes by the sales. Further, to explore factors that influence profit margin, we can compare a common size income statements. A common size income statement expresses each component of net income as a percent of sales. Exhibit 6.3 presents common size income statements for Taylor and Taylor. The advantage of a common size statement that is allows the analysts to identify factors responsible for the changes in profit margin. For example, rising product costs that are not passed on to customers might be reflected in higher cost of sales. As a percent of sales, the lower gross profit margin, similarly holding unit costs constant as the change of pricing policy, might be evident from a comparison of gross profit margins. Administrative and market efficiencies may also become more apparent when direct effects of growth in sales are removed.